Joining us right now is OppenheimerFunds Chief Investment Officer Krishna Memani. Krishna, great to see you this morning. Thanks so much for joining us.
Pleasure to be here.
How are you handling all this volatility?
Well, it's not pleasant, it's not fun, but at the end of the day, it's part of the markets. Having said that, I think what we need to focus on is the underlying economic strength. The economy continues to do well. Rates are relatively low. So I think we are still looking for a positive outcome in the long run.
Would you buy stocks here, or you want to raise cash?
Absolutely. I think cash is a good alternative, but if you have a long-term, if you want to retire, 2-3% just doesn't get you there. So you'll have to take risk and earn returns in the long run. And I think equities are still very good value in that context.
How much of the volatility that you've seen recently do you think can be attributed to the reduction, the $50 billion a month reduction in the Fed's balance sheet, now below $4 trillion. You had some serious liquidity and trading problems in the markets last week where you had those exchange-traded funds, those bond ETFs, where the actual trading price was below the net asset value, which isn't really supposed to happen, which tells you that the investors didn't really know what the bonds in those portfolios were worth. How much of that is contributing to the overall market swings? So
the balance sheet reduction at the Fed is clearly a factor in the market. Reducing liquidity in the market is an issue. I think volatility causes ETF prices to be away from what their net asset value is all the time. So I don't read too much into that. But the Fed, if it continues to tighten or if it continues down the path of reducing its balance sheet in a very aggressive way, I think that'll have negative consequences in the market. Having said that, we believe the Fed will stop sometime in the first half of 2019 because the economy would have slowed down and the inflationary pressures that they are worried about just won't manifest themselves. So maybe 1 or 2 times tightening and the Fed stops. So if you step back, there are 2 issues driving the market: the Fed, tightening by the Fed, and trade. And I think we are on the verge of resolving the Fed issue. Trade issue is an open political issue that, somebody can solve that problem tomorrow if they felt like it.
Well, there was a phone call last night. They're talking about this being a new round of trade talks taking place last night. Treasury Secretary Stephen Mnuchin and U.S. Trade Representative Robert Lighthizer held a call with their Chinese counterpart, reportedly discussing agriculture purchases, changes to China's fundamental economic policies, according to the Journal this morning. It comes amid heightened tensions over the arrest of Huawei's CFO. She's waiting to find out whether she's going to be released on bail. That decision could come today. So, Krishna, what do the markets expect here in terms of, looking at these recent developments, from the CFO getting arrested to this Argentina meeting? What's priced into the market?
I think the market is still expecting trade issues to continue for a reasonably long period of time. And I think the driver of that is the fact that U.S. economic strength gives the Trump administration the flexibility to continue this path. However, by the middle of next year, when the U.S. economy is kind of back to 2%, unless the Trump administration wants to take the risk of the economy slowing down even further, I think they will be forced into a situation to make some sort of compromise. So I think the trade conflict continues for a bit longer, but I think even that gets resolved middle of next year.
So is that beginning to get priced into this market, a slowdown? Is that what investment participants believe, 2% next year this time?
Oh, yes. I think in August and September, we were talking about sustained growth rate, higher inflation. I think all of that has been flushed out of the market by October, November.
Well, tech has been a major area under pressure because of all of this trade issues. But you saw yesterday in the comeback, it was led by Apple, it was led by the tech sector, and it was led by the semiconductors, up 2-3% across the board. And you're seeing that actually this morning. The NASDAQ is leading, and you're seeing some of these semis do well again today. Do you think that bodes well? Can these stocks carry us into the end of the year, maybe give us that Santa rally?
Well, I think if there is going to be a Santa rally, it will involve tech in a big way. There's no doubt about that. And I think valuations in tech have improved quite substantially. They have had a significant correction. I think for the long run, we continue to believe that in a trend growth rate where growth is going to be around 2%, tech companies that have been delivering significantly better growth rate, top line, profitability growth will lead that rally. It will never be about value. It'll always be about growth, and it'll always be about tech companies if this rally continues as we expect.
On the Santa rally, we have consumer confidence at an 18-year high. We have unemployment at a 50-year low. We have wages that are up. Looks like we're going to have a really good Christmas retail season. The question is, what happens next? Do you think this is the last big hurrah before we slide back to 2% growth?
I think the economy is already slowing down. The consumption part was always robust. What we needed was capital spending. That ticked up a little in the first half, and subsequent to that has been slowing down. So I think that's the part that is missing, and that is what ails the global economy. The desire to invest on businesses part is just not there. Things like trade issues make it even less so, and I think that's why we need to resolve it.
You didn't mention Brexit at all. Brexit yesterday, the market dipped significantly, came back later because of what could or could not happen. Does Brexit factor into this in a big way next year?
Yeah, but Brexit is a gift that keeps on giving, unfortunately. The likelihood that they will get a deal that everyone would like is basically zero. So we will have to reach some sort of a compromise. It's political posturing on all sides. But at the end of the day, before middle of next year, they have to find a solution.
The United States has been kind of the stronger of the global economies, broadly speaking. You've got Germany is now contracting, Japan contracting. Can businesses here in the United States up capital spending? How does the rest of the world impact what happens here at home?
Well,
Does that make sense? Like, I know we don't operate in a vacuum, but can you see an uptick in capital spending if the rest of the world doesn't look so great?
Well, so I think that's a fair point. If emerging markets were accelerating and Europe was accelerating, I think the desire to invest to support those markets would be higher. But U.S. has been the fastest growing market for quite some time, or at least the relative to trend has been the fastest growing market. With that, if the investment didn't come through, the likelihood that it'll come through when the U.S. economy slows down to 2%, I think is less likely.
Bottom line, do you want to buy stocks or allocate some money to fixed income right here?
No, I want to buy stocks.
Okay.
I think stocks are good for the long run. They have cheap valuation. Economy is doing quite well, and markets are going to go up over the next 2-3 years.
Krishna, it's good to see you.
Thank you.
Thank you so much. Krishna Memani from Oppenheimer there.